Hello and welcome to Financial Fridays with Dawn, where I come to you each and every Friday to empower you to live a happier, healthier, and wealthier lifestyle. So last week I asked what you guys would like to hear about, so thank you. I had one of my clients reach out. So today's topic, we're going to discuss the different types of life insurance, particularly the difference between whole life and index universal life. So that way you can get a better understanding of them both. Now, they're both a type of permanent life insurance, which means it's always going to be there, where term, basically you pay for a certain amount of years and then it's gone. So this is permanent, that's hence the name permanent life insurance. So let's start with whole life. Whole life is the traditional insurance that's been around since the beginning of insurance. It's basically, you pay your premiums, kind of plain vanilla, you pay your premiums, your death benefit's going to be there, it's going to grow. It does pay dividends, although dividends are not guaranteed, but most insurance companies, since they've been around, have always paid dividends, even through the Great Depression times. So now what you do is you pay your premium, part of it goes to fund the cash value, and obviously part of it goes to pay for the death benefit. And each and every year, you're going to see that cash value increase as you put a premium in, and it just keeps going up and up and up. So it's probably average about long-term, about 4% the internal rate of return. Now, as we talked in other videos, that's not mentioning what you could do with that life insurance. For example, Walt Disney World borrowed against his New York life policy and started Walt Disney World. So you can't measure the rate of return on that because that's infinite, basically. So again, guaranteed cash value increases. You get dividends every year, which could buy more paid-up additions, more insurance. You can get the dividends at interest. If you forget to pay the premiums will automatically be paid from the cash value, or you could have what they call extended term insurance. And at some point, you could pay it guaranteed, paid up at age 65, a 10-year pay for whole life, a 20-year, it all depends. But that's kind of like the basic life insurance that came out. Then there's index universal life that came out. Now what this is, again, it's still going to have cash value, but rather what it's based on is an index account. You can pick the S&P, the Russell 2000 index. There's numerous indexes that you could pick. So you're going to, the premium goes into the bucket, part of it goes to the cash value, part of it to fund the death benefit. So now just instead of being in the general ledger as it is with whole life, you're going to take that money. It's going to be still in the general ledger, but that interest that is credited to you is going to be based on what an index performs. So, and there's usually a cap. So one of the companies I like to use, their cap is 11.5%. So what that means is if you put it in that particular index and the index does 20, you're going to get 11.5. But the nice part is that when the market does negative 30, you just get a 0. So you don't have any of the losses. So you can get a lot of the upside to that cap and none of the downside. So in the long term, you can generally average about 4 to 6, 7%, depending how long the contract is and how the indexes perform. Again, you still have that guaranteed death benefit. It's always going to be there if you die. But what happens with IULs is that you could set them to run for a specific time, and then after that time, usually there'll be enough cash value to support the premiums going forward. So that's just a little brief introduction. If you would like to learn more, as always, you could go visit my website, dsfinancialstrategies.com. So now, who would these actually benefit? So whole life, what I like to do is start with whole life. You just basically your base insurance, because you're going to have more than one insurance plan throughout your life. So start with the whole life as your basis, and then, so you have that, then you could build on, like usually anyone under 40 should have a whole life, unless someone really wants to take an IUL. And then you could go along with the IUL, usually like in your 40s, because they want to make up that more for the cash value growth. But like I said, I like to build all the plans with the base. I myself have the whole life first. Then I'm going to layer on some universal lives and then possibly some more whole lives. But you want that base guaranteed. Because here's something that could happen with an IUL, again, because it's based on the indexes. What if for the first 3 years you get zeros, which we saw that back in the 2000s with the market. So now your policy is going to look as if you're losing money. You're not really losing money, you're just not getting credited, and the insurance charges are coming out. So for someone who might not like to see that, I like to start with that base for the whole life so you have that and you have diversification on there. But again, long term, it's going to do well. And the companies that I've been running, I've been in the insurance business now for 13.5 years, and the illustrations are basically matching up with how they're performing, especially my whole life policy, which back in the day wasn't the case because they were projecting high dividends, high interest rates, and all that. So now insurance companies have gotten conservative in their numbers, so that way it's more in line. But again, it's still just an illustration, so it's not set in stone. So you just look at your statements. Oh, and here's another thing I didn't mention about the cost of insurance. Every life insurance has a cost to it. Now with whole life, it's baked in there, meaning you're not going to see it as a line item on your annual statement. With index universal lives, as with all universal lives, you're going to see the cost of insurance charges broken out and the expenses and admin fees. And that'll increase every year because as you get older, it costs more to insure you because there's more likelihood of chances that you're going to pass away as you're older. So that's just how another difference in that. But either way, both policies are great. And especially the one thing with index universal life, you want to make sure your max funding has like we talked about before in previous videos. You're paying more than just the cost of insurance and to keep that death benefit. You're putting more so it goes to that cash value to earn more interest for you. So I hope this was kind of helpful to explain the differences between the two types of permanent life insurance. And as always, if anyone has any questions about any financial topic, anything to do with their personal finances, whatever you want to hear about money, send me an email, give me a call. Also, I'm always available to offer you a consultation. So again, that website is dsfinancialstrategies.com or call me at 215-660-0288. Thank you and have a great day.